Matt, the Mortgage Guy, Mortgage Mondays, episode 118. Should I pay points on my mortgage? Matt, the Mortgage Guy, Mortgage Mondays, episode 118. Should I pay points on my mortgage? Now, this is a really awesome topic and really something that I've seen a lot of creative stuff done around recently in my business and with my clients, buying the rate down and whatnot. And what I'll say first off, before we get into details about scenarios, it's always going to depend on your specific scenario. How long you're going to stay in the house, what your wants and needs are, how much income and disposable cash you have when you're buying your house, things like that. So it's always going to take really digging into your specific scenario to properly advise somebody, but I'll just give some basics and some scenarios so people can kind of decide if it's something they might want to explore. First and foremost, for those who don't understand what points are basically a fee you pay to lower the interest rate. And on the flip side, you can get a higher interest rate and get those points credited back to you from the lender. I'll give an example, a simple example so folks can understand what that means. Let's say based on your credit score, your down payment, your loan amount, your rate where you don't pay any points is 5%. You're always going to have the option to pretty much pick your rate, and as you go down in rate, 4.75 or 4.5, it's going to cost you. And if you choose to pay to lower the rate, in this scenario where it's 5% at no cost, let's say 4.75 costs you 1 point. If you've got a $400,000 loan amount, 1 point is 1%, that's a $4,000 cost. You want to go down to 4.5% and that costs 2 points, that's going to cost you $8,000 because 2% of your $400,000 loan amount. Now some folks with limited cash say, hey, I'll take a 5.25. The lender's going to give me a point in credit. They're going to give you $4,000 towards your closing costs. Or 5.5, I'm going to get 2 points in credit from the lender. So as you can see, it's a sliding scale. If that doesn't make sense and you want to see that and give me a call, I'm happy to help go through that with folks all the time who don't really understand how that works. It's not super complex, but some folks need to see it written down a certain way or explained a certain way to understand it, and I'm happy to do that, so reach out. So about scenarios, some interesting things I've seen, especially right now. We're in a market where a lot of folks are having issues with affordability, so during my initial consult, we're talking about, wants, needs, goals, dreams, and they usually have a number. This is my number, how much I want to pay per month, and I don't want to go over that. And I applaud folks for having a specific budget, and this is what they want to pay. Then we've got sellers who say, I've got to sell for this amount, and this is what I think my house is worth. And honestly, right now, we've got some unrealistic sellers that think that they can get more for their house than they probably will or can. And then we've got buyers that say, this is my max. This is the max I'm willing to pay. So this tool that I'm going to kind of present has really helped bridge the gap. And I'll give it an example because I think that's how most people learn is hearing the numbers and seeing the numbers, and that's a way to really understand it. For me, especially works that way. So in a market like we're in right now, sellers are starting to give concessions, especially in the winter time. So we're in fourth quarter of 2018. As there's more and more inventory on, buyers have more stuff to choose from, they can ask sellers to give concessions. So here's something we've done, and I really think it's powerful. It helps a lot of my buyers out, and it honestly gets the sellers what they're looking to net as well. So it's a win-win on both sides. Specific example, let's call it $635,000 that the seller says, I need to net $635,000. That's my number. Okay, if you, as a buyer, went in at $635,000, put 20% down, and had a $508,000 mortgage, at 5 1/8, for our example, I'm not quoting rates, this is just for our example, at a 5.125 interest rate, your principal and interest payment is going to be $27.65. So somebody says, well, gosh, that's more than I want to pay. Taxes and insurance included in that, it's probably in the $3,500 range, whatever that payment is. But they say, that's just a little bit more than I want to pay. here's something we can do. Offer as a buyer, and this is through your agent of course, $645 with $10,000 in seller credit. So you're getting $10,000 in credit from the seller, and they're netting the same. They're netting $635. It's no difference at all to the seller. But guess what happens? $645, 20% down, $516 loan amount. With that $10,000 in seller credit, you buy the rate down to 4.625. Now your payment's $26.52. That's just principal and interest, remember. That's not tax and insurance. But you're saving $112 a month. The seller's getting exactly what they want, the $635. So it's the same as the first scenario, except for you're paying $10,000 more, getting $10,000 in credit to improve your mortgage. Now this makes a lot of sense if you plan on staying in this house for a long time. You've got a lower interest rate, and over time that is going to make up for that $8,000 more loan amount that you started with. Because that's the one drawback. If you're only going to be in this house for 2 years, that doesn't make sense. But if you say, hey, this is my forever home and I really want to stick with this payment because it works with our budget, that's a way to get buyers the payment they want, and really the sellers, in their head, I think, and something psychological about $645 with $10K in seller credit sounds better than $635. I don't know. Agents can chime in and let me know if you guys agree, but that's just been my experience. So anyhow, neat things like this. I've had plenty of conversations around this. I've actually even had buyers that said, you know, we're going up to $708,000 because that's where the payment is comfortable to us. And they've got a house they really, really like, but the seller's stuck at $739. Well, let's start talking about what $720 or $725 with $10K in seller credit looks like, buying your rate down. Because then you're at a lower payment than you were at a $708 purchase price. So the seller's more likely to accept your offer, because at $708 they didn't even counter. They just said no thanks, moving on. But with this, if it's something you're going to live in for a long time, buying that rate down, and especially when you get the $10K in credit from the seller, you don't really feel that you're spending $10,000 to buy the rate down. If you save $100 or $150 a month, it's a 4 or 5 year break even. If you're in the house longer than that, it really makes sense. Any questions at all, please feel free to reach out. This video got longer than normal, but hopefully it provided some good value to anybody who's considering buying the rate down or paying points. And maybe in a future video I'll go in the specifics of points and maybe even show some graphs on how that all works. But it's a great tool in certain scenarios. Until next time, Matt the Mortgage Guy.